we'll be starting today. We'll be trying to reinforce the institutional order flow. I see a lot of us trading, and we say we're trading the institutional order flow, but we're still trying to get some things mixed up. So we'll just quickly do a reinforcement of the institutional order flow. I must state that some of the concepts used by the institutional order flow um, are borrowed from ICT, Michael. So you could go watch some of his free videos on YouTube with regards to order blocks, breaker blocks, reclaim blocks, mitigation, breaker, and the likes. I'm aware that the way we define some of these terms based on the strategy we're going to discuss today is slightly different. But another block is another block, basically anywhere. So today we'll be we'll be trying to reinforce that theory again, so we could all have a clear grasp of what we need to do and why we need to do them. But before then, I must state that I noticed many of us trying to trade everything in the market. Unfortunately, you can't trade everything. You can't just trade everything. There are no setups or reasonable setups every single time of the day on a given pair. There might be setups, on some other pairs, but if you're focusing on a particular pair, there won't be setup every single time of the day. You have to wait for it. And I tell you the truth, sometimes you might need to wait for 2 days. Sometimes you might need to wait for a whole day for your setup to play out. There are times of indecision where you just have to sit on your hands and let the market tell you what it wants to do, and then you flow with it. Right? So again, we need to understand that price does basically just 3 things. It is either, just a minute, please. Do this. It's either price is trending, price is ranging, or price is consolidating. So it's either it is trending upwards or trending downwards. And we say for price to be trending upwards, it has to make consecutive higher highs. In fact, we took out time to say, if you understand price movement in this way, even if you've been a trend line trader before, you will still be able to make sense of the institutional order flow, right? Because for you to say that price is in an uptrend, you have to be able to have 2 points, 2 highs, and 2 lows. So invariably, what I'm saying is, if price does this, you are not too sure what the trend is. You can't say it's an uptrend, neither can you say it's a downtrend. You need to have consecutive highs and consecutive lows for you to say price is in an uptrend. And usually, trendline traders, we draw a channel touching both points, and they say, okay, price is in an uptrend. So we need to see price making consecutive highs and lows for us to conclude that we are in an uptrend. Somebody is saying you can only see my dashboard. Is that true? I'm presently on TradingView. Can you see TradingView? Oh, I'm sorry. My bad. Okay, I'll quickly repeat what I just said now. Okay, but I believe you can see Trading View now. Can you see Trading View now? Madam Sarah, if you're in a quiet place, you could unmute yourself. You're a co-host, so I can get feedback easily from you.
I can see the Trading View, sir.
All right, great. Let's move on then. Our price needs to make a high, a low, another high for you to say you're in an uptrend. And because the institutional order flow is a trend following strategy, we try to sit out a particular pair when we can't see vivid signs that the market is trending. When we are not sure that the market is trending, we sit it out. So I was trying to say that if price does something like this, just 3 points, we can't say if this is an uptrend or a downtrend. We need to see it do something, create one more leg to the upside for us to say it's an uptrend, because price could just do this and then come down, right? So you need to have 2 consecutive highs and 2 consecutive lows to say you have a trend. And I said, usually trend line traders will do something like that, right? They draw some lines like that and say we are in an uptrend. You want to see this happen before we begin to trade, right? So what that means invariably is that when price is indecisive, we are not trading, we are not taking any position here, except we have a higher time frame bias that will help us take this trade. We sit it out. It needs to pick a direction. And usually what happens is that when it picks a direction, so let me draw it the way I'll really want to draw this. So let's start with series of consolidation. So price is doing something like this. This is a painful period for trend traders, right? Because we're not too sure what price is doing, right? It's just moving up and down. Of course, if you have a higher time frame bias, you could trade up and also trade down. But I'm assuming that many of us are basically new to trading, and by saying new, less than 3 years. So you might not have been able to develop this psychology to be able to trade or even hedge your trades, right? So with this, when you have a ranging market like this, you basically sit it out and wait for price to make a decision. If you have a higher time frame bias, you could be anticipating to break to the upside, or you could anticipate to break to the downside. You could do that. But from my understanding, and I don't claim to know everything in trading, but from my understanding of the market, the market makers or the algorithm that pushes price tends to want to go against the majority. And when I say the majority, I'm not talking about majority in terms of numbers of traders. I'm talking about volume of money. And you and I are into trading not as a way of whiling away our time. We're into trading to make gains, to make profits. Now, I'll give this small analogy before we go into the order flow itself. So say you have price in a range, there would be buyers. Let me annotate here so we'll all be on the same page. Permit me to annotate. There would be 2 types of stops up here. We'll have the buy stops for breakout traders who will be anticipating that as price breaks to the upside, they will buy. So they'll place a buy stop. Then we'll also have stops for the sell. So let's say someone took a sell from 0.3 to 4. Where would that person most likely put the stop loss? Their stop loss will be up here, right? So this is also a stop. such that as price goes, if price makes a U-turn and goes this way beyond their entry, this will be a safety stop. So they have liquidity sitting here in terms of buy stops and sell stops. We also have liquidity sitting here in terms of sell stops and the stops for the buyers. Now, what I want you to have at the back of your mind is this. If the volume in terms of the buyers is $90 billion and the volume in terms of the sellers is $60 billion, the market maker will most likely initiate a long first to get these guys into the market, because as at this point where it's like a part of it, it want to generate what we call an open interest by engaging these guys, and thereafter there is a possibility, high possibility, that the market maker will move the opposite direction, right? And what happens? These guys are losers. And even these guys that are here, the 60 billion, the market maker will seek to shake some of them off by moving price back and forth several times until some of these guys, get liquidated and added to this 90 billion of losers, and the market maker could walk home. These are hypothetical values. And again, I'm not an expert in this thing, just sharing my knowledge, right? So this will be like 120 billion, for instance, that the market maker may take. But notice that the market maker basically went against the majority, which is the 90 billion. And I've shown us this before when I took us to IG sentiment. Here, I took us to the IG sentiment report. And I'm saying this deliberately because over the last 2-3 months, I've seen some of us get worked up, depressed, that we turn up to our charts and we are really not getting some trades. And some other people tell us target smash, and it looks like you are losing out. You are not missing out of everything, of anything, if you have your trade plan and you wait for price to come to you, right? So you could go into this is the IG sentiment. Let's wait for it to load up a little. I just want to show us something here so you could understand what I'm trying to say. Believe it or not, this red line you are seeing here are the retail traders, right? So when the retailers are selling, the banks are actually buying. When the retailers are selling, the banks are actually buying. The banks actually run what they call a contrarian trading style. So let's read this briefly. Retail data shows 51.63% of traders are net long, with a ratio of traders long to short being at 1.07. So this is even very close, right? There are some times that this will be very, very, the difference will be clear, right? So, and what did they say? We typically take a contrarian view to crowd sentiment, meaning that they will go contrary to the crowd sentiment. So the fact that traders are net long suggests that AUD/USD prices may continue to fall. If we go to the chart of AUD/USD, it's most likely we might find it falling, right? We might just find it falling. I'm looking for, okay, right, fine. So let's come here and go to AUD/USD. Put it here. Right. So what do you notice? AUD/USD falling. Why is AUD/USD falling? It's because the majority of traders are net long. You go to any broker's site go to any broker's site. I think I can safely do this here. Let me go to Infinox. Go to any trader's site. Infinox. Let me see. Let me see here. Now I need to say this because I see, like I said, many of us being jittery, like you are missing out. Don't be in a hurry to add yourself to the number of losing traders. You need to be able to wait for certain things to happen. Then you take your trade. Don't get blown away by guys who tell you to make they flip their account in 1 week. What happened the week before? What's going to happen next week? Are these guys still in the market? Or they've grown their account? So just see this. This is just one broker. You could try this with every broker. It is mandatory that they state this. They have to state it. Now, so you see here, CFDs, and under CFDs, you have Forex, here, Forex indices, equities, and commodities, right? They form the CFDs, right? So CFDs are complex instruments and come with a high risk of losing money. Not just losing money, look at it rapidly due to leverage. Now, with this broker, somebody's writing on my screen, with this broker, 70% of retail investors' accounts lose money when trading with this broker. Now, you could go do this. I don't care who your broker is. Go check. It could be ICM, whatever the broker may be. They will state it somewhere on their website. They have to give that detail somewhere. Now, 70% of retail traders lose money. So we might be over close to 2,000 on Simply Pips and every other Forex Telegram you may know. You could assume that 70% of everybody there is losing money. So when you have made your trading plan and you intend to trade EN for today, and somebody is saying, oh, GU is jumping, and you forget about your EN trade and you're running to go trade GU, just have at the back of your mind that you might be chasing someone who is part of this 70% of retail traders. And that's why in Simply Pips, you don't see me or any of the admins, flashing our results, because this business is not to entice you. Is to help you to be matured enough to take trades based on your trade plan. Let's come back here. So very good. I just give you an example of AUD-USD. Right. So let's go to, or let's look for another one. Let's look for another pair, just so you could understand how this works. Here is the Euro CHF, right? Retail trader data shows that 69.6% of traders are net long, with the ratio of traders long to short being 2.29. Now, again, the number of traders net long is 3.21% lower than yesterday. So some of them are beginning to realize that long is not the way to go, and 9.05% lower from last week. Now, note this again. We typically take a contrarian view to crowd sentiment, meaning that we'll trade contrary to the crowd sentiment. And the fact that traders are net long suggests that Euro CHF prices may continue to fall. Ladies and gentlemen, again, let's come here and call up the Euro CHF. Right, let's call up the Euro CHF so we can see. So here I have the Euro CHF and I'm putting it on the chart. Right, so let's see Euro CHF. So what has Euro CHF been doing? Euro CHF has been selling. Why is Euro CHF selling? Majority of the retail traders, 69.6%, are net long. You see the reason why you don't need to follow what everybody is saying. In politics, they say majority carry the day. When you go to vote, they count the ballots and the majority wins. Well, ladies and gentlemen, in Forex, majority loses. And that is why, even in the mentorship, the fostering program we're trying to innovate and look for things that are not common use. Even if you want to be an indicator trader, can you find a way of interpreting your indicators, should you want to be an indicator trader, in such a way that is not common? Because what is common loses money in trading. So we try to stay out from the market when it is consolidating. Now, because based on our present level of understanding, we might not be able to know where price will eventually go to. There's high probability you might be able to guess it when you know how to understand, interpret the open interest, which eventually gives rise to the commitment of traders, the COT. But the joy of institutional order flow is that as a newbie, somebody less than 2 years, 3 years in trading, you might not want to bog yourself so much about sentiment, commitment of traders, open interest, and the likes, and even some fundamentals like interest rate and the likes. You might not want to bog yourself so much with them, but you will still be able to be profitable if you stick by certain rules. And the rule is that let the market maker, let the big banks deal you their hand first. Let them break out from that range. When they break out from that range, now you know they are buyers. And we're not talking about just a slight breakout. We're talking about an impulsive move, an impulsive move, a deliberate breakout, something massive. When that massive move happens, right? When that massive move happens, what usually happens to retail traders is that we become sad, right? Our faces look something like this. We become sad, or even maybe surprised. Oh, I missed that massive move. Ladies and gentlemen, you didn't miss anything. Let the massive move come. Let it come. If you can't predict that the massive move will come, let it come. The reason why most retail traders keep losing money is that they try to guess where price will make a U-turn from. So when price is selling, they are saying, oh, it has sold for so long, it must buy now. And the big guys cannot keep selling if there is nobody at the other side to buy. I think in one of the recent videos I did, a Zoom we did about 2 weeks, about last month, I tried explaining open interest. And I said open interest is when you match a buyer with a seller. When you say you are going long on GBP USD, it simply means that you are selling USD to buy GBP. Somebody has to be selling the GBP to you. So a buyer meets a seller and we say we have one open interest. So the banks will continue to sell so long retail traders keep thinking, oh, it has sold for so long, it has to buy now. It has sold for so long, it has to buy now. And as retail traders keep saying it has to buy now, it has to buy now, they keep getting in a buy position and the banks keep selling. They'll hit some people's stop loss. Those guys will go out and fresh retail traders will come in and say, no, I think it has gone down now for 3 days. Now it's time for you to buy. And so long you keep doing that, so long you and I keep doing that, price will keep going down. That is institutional sponsorship, right? So it's not a game of guessing. You want to find it's a game of probability, but you want to wait until the odds are stacked in your favor. Meaning you could be in front of your PC all day and not take a trade. You could say price will do this. You are happy if price does it. you necessarily may not be in that trade. So you wait for price to make 0 to A, that is the impulsive move. And once price has done point O to A, now you are sure that the banks will most likely be buying. Then you wait for them to pull back into discount level for you to begin to anticipate a buy. So you miss out from O to A. And I tell you, you should even miss out from A to B. Now at point B, you begin to frame up reasons why you should go long based on the order block that would have been created around this level. Now you begin to anticipate reasons to go long. Right? So enough has been said about that. Let's come back to the theory itself. So when we have, I think I'll quickly give an example here of traders being trapped up and down, so we get a clear picture of what I'm saying. It happened yesterday on Euro USD. Euro USD was in a bearish terrain, but notice what they did yesterday. Let me magnify this a little. Notice what they did yesterday. This is the Asian high. They stop hunted the guys that have been selling from this level, right? You notice that this level here, sorry. All right. So this is a significant level. You notice that 2 touches to that point and price drop. Some guys were selling from yesterday evening when or to the night before when price bounced off the 50 EMA. So in the Asian session, it went all the way out, took out their stops, and now gave us an M pattern, the almighty M pattern there, and then began to sell. What did price do again? If for the guys who were buying, their stop losses would have been somewhere here, right? Either at the Asian low or even at this significant low. And they took that out. They practically took it out through something that looked like a doji and then went back up. Now, for the guys that were selling from here, again, their stop loss would have been here. And again, they took them out. They took them out again and then made a massive move to the downside. If you missed this move to the downside, well, here is your entry for a sell. You don't have to catch this if you don't know what to do. And that's what I'm saying, right? If you had caught it from here, there's every likelihood it might have thrown you out somewhere here. So we need to be able to know precisely what we want to do with the market at every point in time. Now let's go back, and we might need to add some tempo to what we're discussing today. So what is an order block? A bullish order block is the last down candle. A bullish order block is the last down candle at a point of resistance or consolidation before a massive rally to the upside. So this was the last down candle before this massive push to the upside. I mark up this last candle here as an order block. The bearish candle is the bullish order block. Right? What is a bearish order block? A bearish order block is the candle or the bullish candle with the widest spread, right, before a massive sell. So again, this candle here becomes my bullish order block. My bearish order block, I beg your pardon. The bullish candle becomes my bearish order block. Now there are lots of confusion as to how to mark this up. Should it be from wick to wick, or should it be just the body of the candle? It doesn't matter. Just pick one and stick to it, right? I prefer to mark up the whole of the week from top to top, especially if I'm doing this on a lower time frame like the 4 hours. If I go to the daily, it might be different, but on the 4 hours, I want to capture the whole of this candle, includes weeks inclusive. Weeks inclusive. And for the bearish order block, I want to capture the lower week. So for instance, this candle here, if I were to mark up this candle here as my order block, I will mark up, let me look, okay, let me use this. I'm going to use this as my candle of reference. This candle here, right? That's the candle of reference I want to use just so I will explain something. You notice that this candle, bearish candle, the next candle to the right of it has a wick to the downside, right? When I mark up my own order block, I mark up the lower wick. If you understand your candlestick anatomy, you would understand that this bearishness here might also have been responsible for the push to the downside. So meaning that when price opened, when this candle opened, the sellers that were responsible for this sell here pushed price downwards before price recovered and made the push up. So if I want to mark up this bearish candle, it will only be wise for me to also take note of the selling pressure inside the week. Now, different people have different ways of marking it up. This is the way I prefer to mark mine, right? And you could choose to mark just the body of the week or that, but that doesn't still matter. Order block, the concept is the concept, right? So I've been able to explain what the bullish order block is, the bearish candle before the massive rally, before price leaves an area of consolidation or an area of support. And a bearish order block is the last bullish candle before price leaves an area of consolidation or an area of resistance. When price leaves that point, you say you are in you just left a bearish order block. Now let's come down to this area here and see how we'll play with this. Now, so let's see Euro USD trade that happened within the week and see how we might have played this out. Now, we have an order block here, right? We have another block here. Again, we like using red to oh, I shouldn't have done this. Okay, I won't do this. My PC, my job is slow. Let's just continue this. So this is an order block responsible for the push to the upside. Right? Now I must state this again. I have to state this. Your data feed can also confuse you. Now, the data feed I'm using here is IC Markets. If I call up this broker and I go to H4, or maybe I come here, this is Oanda. If you use TradingView, I would suggest you use Oanda to mark up your order blocks. And I have my reasons. I want you to notice this candle here, right? The third candle before the highest high. The third candle before the highest high. I'm going to call up Euro USD from one other data feed on TradingView, and I want you to see something different. Okay, what's happening now? I seem to have 4. Okay, great. So I'm going to call up Euro USD. This is the initial one was Oanda, and now I'm calling up Euro USD from IDC. Now, can you see that this third candle happened to be bearish in color, right? Whereas Oanda had it as bullish. Since this strategy relies so much on not just the color of the candle, but how we label a candle as to whether it is bullish or bearish, I would suggest if you want to mark up on TradingView, then use Oanda for your order block markups. And I traditionally use the data feed of IC Markets, even if I'm going to trade my FTMO account or any other thing I want to trade. I use IC Markets for my data feed. You might want to do the same if you it's not a financial advice, just what I do. So here we have the last bullish candle and bearish candle response for that high. So this is a bullish order block, and price traded up. When price came back to this bullish order block, it broke it to the downside. And when price broke this bullish order block to the downside, we now change the name of this order block and now call it a breaker. We now call this order block a breaker. This breaker has a different definition from the ICT breaker, right? For those of you who know ICT, the way he defines breaker is slightly different from this. So when we say breaker here, we're actually saying break in market structure. Price has been making higher highs, right? And all of a sudden, price has broken to the low, to the downside. We now say there's a break in market structure, BMS. Now, once we have a breaker, the highest candle invariably becomes our source. This is the source of the move that brought about the break in market structure. Our prime trade entry is the retest of the source. I know that I've said in some other videos that you could sell upon the retest of the breaker, but I added a caveat. And the caveat is that it's safer to sell. So let's say you have your source up here. Let me annotate. It seems the network is a bit slow, so it doesn't slow down things. Okay, so here. So if I have my source up here, and I have my breaker somewhere here, when I'm taking a trade, I'm assuming I don't know any other thing. I'm assuming I'm not looking at higher time frame bias and everything. We're just looking at candlestick patterns, market structure. If I want to trade this, I lack the confidence to take this trade upon a retest of the breaker because I know it could eventually go to the source before falling down, right? So I would rather want to take a trade where there is a form of intersect between the breaker and the source. And when price trades into this region, I am sure that it is testing both the source and the breaker. And then my stop loss is even smaller somewhere up there, and I can ride my trade down. But when I have a breaker and the breaker is far away from the source, this is how I love to trade it. I'd rather want price drive into my breaker for a retest, then break down, giving me a new breaker here for me to take a trade from point 3 and ride down. I don't know if I'm making sense. So let's come back here. Now notice that I have my breaker, which is this, the first, the lower order block is the breaker. Traditionally, we would be looking for a sell, an opportunity to sell when price retests this breaker. We should be looking for reasons to want to sell. We might have gotten a reason and then be stopped out, or we might not have gotten any reason as price continue to push up. We don't take a sell based on this strategy until we have a break in market structure on the lower time frame. So invariably, what this strategy is saying is that buy when the market is buying. How do you know that the market is buying? When it starts buying. When will you stop buying? When it starts selling. How will you know it has started selling? When it starts selling. I mean, it's as simple as that, right? So here we are, price is pushing into this order block, which is now our source. We will traditionally anticipate that the mean threshold, in this case, which is 50% of this order block, be a point where price will arrive at for us to want to sell. Again, if you want to use your fibs, ICT fibs, you could draw your fib off of this order block, the order block itself, and look for price approaching your equilibrium or 62 or 7 or OTE to want to take a trade to the downside. But I'm not a fan of fibs, right? So let's just, and I know many of us here might get confused when we start bringing fibs in. So let's leave fibs out of this. So just mark up from week to week. If you are using MT4, when you double click on the rectangle, it will show you this dot at the middle. That is the middle of your box. Put your horizontal line there and anticipate and begin to anticipate reasons to sell from that particular point. Does that mean I can't sell when price touches just the order block, the tip? Of course, I can sell. If I get an LSB from that point, I'll take a sell, right? But the optimal entry point should be the mean threshold. So from that mean threshold, you should begin to anticipate price dropping lower, right? Now, unfortunately, this might have happened off our kill zone. For those of us who trade using some strict regime of wanting to trade during the New York and the London kill zone, so that you don't get addicted to just sitting in front of a PC all day, we might have missed the sell. But again, we're not bothered. Why? This was the last bullish candle responsible for this drop. We simply mark up that bullish candle and wait to see if price will retest it. Price never did. Price never tested that point. And it kept consolidating here, right? Before we round up, I want somebody to remind me that I want to show you guys one trick on how you can avoid consolidation. In fact, somebody can just type it in the chat box right now. So when I go through the chat box, I can remember to do that. Right, so you'd notice that this low was the low created as a result of, right, this move to the downside. Everything here didn't break it down. And then we have this bullish candle responsible for this low. Again, how do we mark this up? Remember I said, if we're marking up a bearish candle, I want to take the wick to the lower side. If I'm marking up a bullish candle, I want to take the wick to the upside. So notice this bullish candle here, this bullish candle. Buyers were in the market. When this candle opened, buyers still pushed it up before it fell. So I want to capture the buyer's presence there. So I'll mark up the wick to the upside, right? Buyers pushed. Notice, buyers came in at this candle. They came here, pushed, came here again, pushed to the upside before sellers overtook them. So I want to take into consideration the buyers that are in this wick. So when price traded back into the mean threshold of this wick, which happens to be this red line here, I will begin to anticipate reasons to sell. I will begin to anticipate reasons to sell from this point. Let's go down to 15 minutes and see how we might have gotten in on this particular trade. So here we are. Remember again, we're doing everything here on the 4 hours. So when price traded into this candle on the 15 minutes, we were basically looking for reasons to sell. So let's put a horizontal line on this candle. So it shows us this of 15 minutes down on to 15 minutes. Boom. So here we are on 15 minutes. So you see price traded up here and we were looking for reasons to sell. Again, if you trade BTMM, you had your M formation, you had your close beneath your 13. Let me quickly add the 13 exponential moving average. For those of you who trade BTMM, you have your 13, right? And you have your sell. For those of us that trade LSB, we will be looking at entering the trade when price broke this level, right? So this was the last bearish candle responsible for that high. Price came back and broke it to the downside. We will be entering upon a retest of our close of that candle. So here we are with a stop loss of about, this is 13 pips, add like 2 or 3 pips, so that would be 15. And price came back. This gave you a 1:2. So if you reach 1% of your account here, here you have another 1%. So traditionally, I've mentioned it before, I take 2 trades. I take 2 positions. When I sell off from this level, once it hits the first TP, which is 1:1 or 1:1. It used to be 1:2, but I recently discovered that the market has been so choppy lately. It's been very difficult to make 2%. Sometimes it just reverses at New York, like you can notice on the chart here. So, and Michael keep telling us, pay yourself, right? Pay yourself. In fact, if you take ICT's FIB, your profit scaling is basically a 1:1 or thereabout, you know. So you want to take 2 positions. You want to have 2 positions upon the break of this. You want to have 2 positions when price breaks beneath and does a retest. That is your entry there. Once you hit 1:1, so let's say your stop loss is 20 pips, the first take profit will be 20 pips. Once that happens, you move price to your break even, or if you are anticipating a massive move, you could still leave your stop loss above, so that when price comes back to your stop loss, you basically have made nothing and you also have lost nothing. You decide your trade plan. We're not discussing trade plan here today, right? So all of this was a reversal to go back into that order block and take liquidity. It's just to go and pick up liquidity, and then you have the high, the lowest candle responsible for that high, and price breaks it, does a retest and dropped. So for Euro USD would have been in a sell all the way from this particular region here, and again continue the sell up till today, right? So traditionally, where would we be getting out from if you're using the LSB? Notice price kept respecting the order block, and at this level, we have a break in market structure. Here is the bullish candle responsible for this low. Price tested and price broke above it here. So if you want to get out of this trade, you would have been getting out at the close of this candle, which is at 1.17400. Of course, there might be a higher time frame confluence for why you want to get out. That's not what we're discussing today. But again, I'll just quickly state it. If you go to the higher time frame, which is like the daily, here you have a down candle and you have a push up. This is a bullish order block. And when price trades into a bullish order block, what did Michael say we should do? Is take a profit and wait to see what price will do. Trying to predict what price will do every point in time is a for dashing your money to the market makers. The All right, I'm sorry, guys. My internet went off there. So let's clean up all of this thing we have here. Right now, I want you to see, notice, I'm going to explain something here and why we need to be patient, guys. We need to be patient. So here we are. This was the last bullish candle responsible for this low. That's the bearish order block, right? Traditionally, I would mark up this large candle as my order block. Why? This candle is basically engulfed by this large one, is within the range of this wide one. I would want to consider this wider one as the candle that was violated to the downside rather than this smaller one, right? So when price closed above, this area invariably became a breaker, right? Price came back and retested the breaker to buy. You might have gotten a trade. You might not have gotten a trade. Depends on your trading plan, right? So we have the source down here. Remember, we said we would have been happier when price comes back to retest the source. And then price pushed up, created an order block, never came back to retest it and push up. So if you're trading the institutional order flow on its own, you might not have gotten an entry the whole of this buy. And you shouldn't feel bad about it. You shouldn't feel bad about it, because a profitable trader is a trader who has a fixed way of seeing things and will not be perturbed no matter what any other person says, because his or her trading conditions have not been met. The whole world can go ablaze. A trader, a profitable trader, is somebody who has a trade plan. So if your trade plan didn't give you an entry in the whole of this massive move to the upside, you simply wait. If you have another way of trading, maybe you trade BTMM well, you might have gotten an entry somewhere. So when the BTMM guys are counting levels and you don't trade BTMM because you feel, okay, it's clumsy, I don't understand the levels, let it go and trade what you know. Eventually, if you missed out of this buy, here you are. You caught this sell. I mean, I need to see people in Simply Pips showing that level of discipline in taking their trades. Don't be in a hurry to do everything. Now, the US elections are upon us, and several things are happening. There's going to be a lot of volatility on US related pair. I'm assuming there's going to be. And if volatility occurs, some people may make a lot of money, and some may give their money out to the market. If you are inexperienced, I would advise you look for some other less volatile pairs to trade. And I'll give us an example of how massive it is and how sane it is to trade some other pairs as regards the majors. Now, the majors are, especially GU and EU, are the most traded, and therefore their spreads are low, right? But the manipulations are higher. And if you have not been able to master your emotions enough to decipher when the manipulations are happening, you might as well have just go trade some other less manipulated pairs. And again, if you come into IG sentiment here, you could basically just see it, right? You could basically just see, I mean, you can see the website here, just go through it and see what I'm saying. You would notice that there are some pairs that are not as highly manipulated as the Euro USD. See the Euro USD. Look at the marks difference between what the banks are doing and what the retail guys are doing. Now let's go on to Euro JPY. Difference is not that much. Let's go to Euro GBP. You can see the difference is also not that much. You see some level of intersection because the manipulations here are not as massive as it is in Euro USD and GBP USD and the likes, right? Again, I'm not giving a financial advice. I'm just telling you what I feel could help you. So I'll give you an example of a trade I took today and how well it went. Not looking at the USD and the JPYs and everything. And is a pair very many people do not even look at all. That pair happened to be the AUD NZD. AUD NZD. Let's look at it here. And you'll be amazed what some of the things will leave on the table while we try chasing what some other persons call the majors, right? So AUDNZD, in case you don't know, these dotted vertical lines on my screen delineate one whole week, right? So from this point to this point is 1 week and 2 weeks. So AUDUSD started selling from late about 3 weeks ago, close. So it's basically been selling for 3 weeks per se. It's been selling for 3 weeks, right? So we had this bearish candle responsible for that high. Price broke it to the downside, and here this is the type we love. We also have our source there, right? So price traded, boom. We might not have gotten an entry, but notice how price kept dropping, respecting the order block. This is the order block, the last bullish candle together with the wick to the upside, responsible for this drop. Price traded into that candle, dropped. Price traded into this candle, dropped. This is the low. So until when price took out, this is one candle here. Price traded into it, dropped, created a new low, and this happened to be the order block responsible for that low. This bullish candle here was responsible for this low. Price traded again, dropped, which is the next candle. This is the bullish candle responsible for this low. Price traded into it, dropped, created a new low here. This is the bullish candle in the psychological level, right? Responsible. Price traded into it, dropped. So this was my trade today. This is the bullish candle, last bullish candle. Last bullish candle, response for this low. Price traded into that bullish candle, sell. I mean, look at it. Price traded into that bullish candle, sell. What's going to be your first take profit? The lowest point so far. Boom, price came to it, almost to the peep. Almost to the peep. Now let's go down to the 15 minutes and see this. On the 15 minutes today, let's see how this played out. So what do we see in the Asian session? It gave us that manipulation to the upside. We had the last bearish candle here, response for this high. Price traded down, didn't close beneath it. Of course, this was in Asian session. This is our kill zone. We are more interested in things happening within our kill zone, which happens to be this point, right? This was the last bearish candle, response for that high. Price broke it to the downside, and we're in our sell. So your stop loss would have been about, give or take, 20 pips. That's giving you 40 pips, that's 2%, right? Again, something I want to quickly show you guys here. I mentioned it in some of the videos on YouTube. Notice how price was dropping. Notice this order block here. Notice this one, this order block, right? Price came here and was consolidating. By the way, if you want to trade AUD NZD, you have to be very patient. It doesn't move as massive as EU, you rarely see those large candles. But ladies and gentlemen, what are we after? Are we after entering and getting out in 2 minutes but getting stopped out more often, or actually getting in and doing the business of trading and getting your profits out from the market? So here, notice price came down here, consolidated. Notice here what is square, right? So when price did this, price created a new low here. So what did I do? I marked up this high, and I didn't want to see price taking out this high. I didn't want to see price closing above this high. Notice what happened here. When price opened here, before this bearish candle, it first pushed up, kept pushing up like it was creating, it was going to go back into my entry. But then I looked to the side and I saw this bullish candle. And you can see between this bullish candle and this bullish candle is a gap. Price just went there, filled the gap, and dropped and never came back to that place. Again, if you're trading, yesterday's low is one of your key TP points. Price came straight to yesterday's low and gave you 2% if you are trading if you are risking 1%, and it gave you 4% if you are risking 2%. It gave you 1% if you're risking half a percentage of your account. And you could have done this today, and it was very, 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 it's been there, it's been selling. It's been selling all through. We could have sold several times from last week, trading just the AUD NZD, ladies and gentlemen. We could have done that. So that is the order block theory. Again, I quickly forgot something on AUD NZD for those of you who love trading indicators. So here you see price made a higher high, oscillator made lower low, price made even a greater higher high, oscillator went low, right? And then we have a break in market baseline somewhere there, and we're selling. So if you want to use TDI, you could. I won't suggest which is best for you. You could use any of them, but the idea is that you're trading the institutional order flow and you're waiting for price to do what price wants to do. Now, I'll drop a nugget here before we begin to wrap it up. Now, when you're trading the institutional order flow on the H4, I want you to always keep an eye on the daily time frame, right? And I'll give you my reasons. So let's come back here. Right, so remember the concept. We are bullish off the 4 hours. So let's say on the 4 hours, we are basically bullish, right? Now we have our order block here. We are looking for reasons to buy from inside the order block. So what do we do? When we are looking for reasons to from the 4-hour order block, what do? We go to a lower time frame, like the 15 minutes, right? We go to a lower time frame like the 15 minutes, and then we anticipate that in the lower time frame, price will be making lower lows, right? Price will be making lower lows until price gets into the order block. And what happens thereafter? Price now breaks structure, which we call a BMS and LSB. So when price comes back to retest this level, we will now be buyers and continue the buy. What buy are we continuing? We're continuing the buy on the H4, right? So we're continuing this buy on the H4. We want to buy from the order block. We go to a lower time frame and wait for price to sell into the order block, and then we buy. Right? So when price sells into this order block, we buy. The price is selling into this order block on the 15 minutes. Now, that was why we said, what does this strategy? Behind this strategy, it is that keep buying until price starts selling. How do you know that price has started selling? When it actually starts selling. Then when will you start buying? When it starts buying, when it breaks this order, 15 minutes order block, then we continue our buy. And when will you stop buying? When it starts selling. How will you know it has started selling? When it starts selling from the lower time frame. Right? So now let's change the narrative. Imagine that you were actually bullish on the daily, and the H4 is selling into the daily order block. The H4 is now the lower time frame. Why the daily, the weekly, or the monthly is the higher time frame. So the H4, which you and I use to determine our order flow, is bearish. But we need to remember that even though it is bearish on the H4, it is bullish on the daily, the weekly, or the monthly. So when it trades into a bullish order block on a higher time, it is only wise for us to take whatever profits we have and sit on the sidelines to see if price will break this structure to the downside, and then we resume our sales, or if there will be a rejection in form of a H4 LSB, right? And then we'll continue our buy. Are we really making sense here?
Yes, sir.
I need somebody to chat me in the chat box if you feel we are really making sense here. Right. So now, thank you. Now, if you are new, ladies and gentlemen, if you are new to this concept, I beg you, if you are new to this concept, pick any two pairs. Pick one major that is not easily manipulated, something like UF, USD Chef, or NZD USD, or even AUD USD. Leave GU and EU for now, please. If you are new to this, pick EU, AU, NU, or UF, or okay, leave USD card, any of those three. Then pick one other one, like don't do anything chef. You can do AN, you can do GA, you can do something else. Pick only two. And between now and the end of the year, learn to mark up only those two and sit down on your hands and wait to see what price will do. And when price does what you want, you take the trade. I can tell you that what most of you do is that you try to monitor 18 to 28 pairs. You would have anticipated a buy, then somebody else, especially maybe somebody like me, just comes to and I will drop DXY, and some of you come to me and say, Bishop, how do we use DXY? And that is why I don't respond to some of you, because when I ask you when did you start trading, I say I just started last year. Why are you looking at DXY? Leave DXY alone. Leave DXY. Some of you have come to even ask me for how you will know the sentiment. Leave open interest alone. Do this thing gradually. So when I show you my bias on DXY, okay, I've seen a low, I'm anticipating that price takes out this low, then I'll be buying. This is my first level of buy. That blue line there is my second level of buy. You don't need to understand all of this, right, to trade the institutional order flow. You don't need to, right? So what I want you to do is just pick two pairs alone. sit down on them. It could be AUD, USD, just AUD, USD, Rwanda, or if you're using your and sit down and see what price is doing, right? So like in this case, what do we have here? We have the last bullish candle responsible for this low. Price broke it to the upside and danced a little, and price seems to be coming back to the source. So here you are waiting to see if price will respect this. And at the same time, you are going to the daily to say, where am I in the grand scheme of things? Oh, in the daily, I'm also in a bullish order block of the daily. Will I see bullishness from here? Or when price breaks this level, where would price be going to? There are some other complicated things like you are looking for double tops, you are looking for liquidity voids, and some of those things. If you get involved in all of them at the same time, you get confused, and that confusion takes like 3 years to undo. Some of those confusions take like 4 years to undo. So rather don't get involved in them from the beginning. Don't get involved. So pick only 2 pairs, monitor them. Imagine you've been trading AUD, NZD, right? AUD, NZD. You would have been saying target smashed, and without necessarily telling us it is GU. You would have been selling AUD, NZD. Just notice what AUD, NZD has been doing. You would have been selling it, right? And in fact, you would have also been in this buy. Notice this buy. Keep respecting the order block. It's respecting the order block like charm, right? On the way down to respecting, did some things here that you might not have understood, but continue the sell down, right? So just do that for only 2 pairs, and you see. So for those of you that will be joining the fostering class, we discovered that a lot of people find it difficult to. By the way, this is FXOB. I use it to make it easy for me to know the order flow. So on the daily, I can see the order flow on the daily, and I can see the order flow on the H4. I could also see the order flow on the H1 if I want to. And it helps me to draw my order blocks too. So here you see my order blocks. It actually draws all of those things for me. All right, but we're not discussing FX over here. So let's see if we have questions before we begin to wrap up. Okay, to repeat the pairs, I think I just did them. Pick anyone, AUD, AU, NU, UF, then any other one that doesn't have CHF, right? Just pick one. It could be, leave out EG too. Leave out EG. Just pick EN or something like that, right? Let's even look at EN. EN, very sweet one, very sweet one, very sweet trade coming out of EN. Let's quickly go to EN so you guys see. Sometimes you have to leave the crowd. In fact, it's not just sometimes. Most times you just have to leave the crowd. So for those of us trading, those of us who have been trading for a while, notice what happened here. This is Euro NZD on the daily, right? We had this range of buys, right? Then notice what happened here. This bearish candle that was traded to the downside, here you have it. Boom. Right, so we had our bearish candle, the downside. Once price took out, tapped there, we became sellers, right? So we would have been selling from this point, selling, and where would we be anticipating price to come to? These equal lows here, right? Darren Flynn is not online. We did this together on Monday, right? And in one other group, I mentioned that we should be looking for buys from this region here, right? When price traded into this order block, I was anticipating a buy. It bought for 1 day and violated it straight down into this region. Now it has taken out liquidity and it bought massively. Why did it buy massively? Here is an untested order block. An untested order block. So when you are trading in, H4, you are trading H4 and you say I'm bearish, you need to come back to the daily to see where am I. Have I traded into a daily order block? If I've traded into a daily order block, I should anticipate some reactions. And that's exactly what happened on EN today. This buy came up from that order block, right? See the markup, came up from that order block. It has hit another order block here. Would we see a sell to continue? Will it come back? Already, we don't have a breaker yet, so to say. So let's leave that and begin to wrap up. I promised I was going to tell you guys how do you run away from consolidation, right? So when you're on 1 hour, when you are on your 1 hour time frame, especially for you guys that trade the BTMM, when you're in 1 hour time frame, for the purpose of this illustration, I want us to forget about the 200 exponential moving average, which is the blue line there, right? Leave it out. You could just leave out the blue. So we're going to focus mainly on the Mayo, which I have colored white here, then the Aqua, which is the 50, and the 13 exponential moving average. Now, I'm going to explain a term called stacking. When you stack, and permit me to use a white board here. So when I have my EMAs stacked like this, I'm in an uptrend. And of course, if I have them stacked the other way, I'm in a downtrend. But notice, if I'm in an uptrend, I want my 13 here, 50, and 13, what are those EMAs again? 13, 50, 200, yes. We're leaving out the 800. I want them arranged like this. And for a sell, I want it to be 200, 50, and 13. I don't want to see the 13 in between the 50 and the 200. I want it arranged like this, stacked sequentially, right? When I see them stacked one upon the other in an ascending or descending order, it tells me I am in a full-fledged trend. And because this strategy is a trend following, for those of us that will be joining the mentorship class, will show us how to trade in a range. When you have a range and you want to trade what we call trading from the fringe, right? We'll explain that. But for this class, for this meeting here, please, if you want to take high probability trade and you don't want to get involved in what I explained earlier on, where you are part of the guys that are, picking, when the market is consolidating, we say that the market maker are filling orders, they are picking orders, right? And they will eventually go against one of these guys. The winner is going to come to Telegram and say, yay, I just made some pips. But guess the guy doesn't know why he made it, so he can't repeat it tomorrow. It's not duplicatable. You want to have a system that is duplicatable, right? So you want to wait. You don't want your 13 to be in between. So let's go to the charts now and see an example of what I'm saying. Go to the charts. See an example of this. All right. Sorry, can you see my screen? Yeah, screen share. All right, so here we are. I want you to do this only on H1, right? And we can basically use any pair. to do this. What will this do for you? It might make you miss some trades, but you eventually be profitable long term because you would be leaving out some consolidations. But if you mix it with institutional order flow, there's no reason why we shouldn't be profitable long term. So, like I said, let's leave out. Okay, let me just take it out officially. Take it out. Make this none. Boom. All right, so I don't have my 800 exponential moving average right now. We have just the 200, the 50, and the 13. Notice here I have my moving averages jumbled together. I'm not interested in what is happening here. It tells me that we're in a consolidation. See, my 13 is up, my 200 is in between, and my 50 is beneath. It tells me that I'm going to be in a consolidation. Usually it may last for 1 or 2 days, right? So I don't want to be looking at this pair. So when I wake up that morning and I see this, I am canceling EN from my analysis for that day, and I'll go look for another pair that is trending, right? I'll go look for another pair that is trending. So notice here, I have my 200 above, 50 beneath, and 13 even further below. This is a trend. So, and this is a downtrend, ladies and gentlemen. When price trades back up here, I will be interested in wanting to find a reason to sell. So whenever price trades back into discount, I'm looking for a reason to sell. I'll be doing this until price trades into a higher time frame order block, which could be a H4 order block, a daily order block, a weekly, and the likes. If I go into H4 here, there's every likelihood that you might have a reason to take a trade here, depending on your knowledge. Price only went back up to fill up this fair value gap and dropped off from there, right? That was what price went here to do. We can pick up any pair, just any pair. Let's take, somebody give me a pair. Let's take EJ, for instance. Right. So EJ on H1, EJ on H1. So on this particular day on EJ, your 50 is above, your 200 is, no, your 200 is in between your 50 and 13. You are not interested in looking for a trade on this day because it's basically going to consolidate, right? You want it to be that your 200 is above. Like, look at this day. Look at yesterday. Your 200 is above, your 50 beneath, your 13 beneath. What happened all for 3 days here? It basically consolidated for 3 days, ladies and gentlemen. The moving averages are telling you leave this pair alone. If you sit down on it, there are days you're going to miss explosive moves. But already, we've explained this earlier. Be ready to miss some explosive moves. Be ready to miss some explosive moves. Go catch the ones that are more certain, right? Some explosive moves will leave from a place of consolidation. We will not catch those ones most times using the institutional order flow because we want the dealer to tell us what he wants to do, then we'll catch the second wave. We don't want to preempt the first wave because we don't have the wherewithal to do that. You don't understand many other things in trading to do that. And you don't have to understand everything to be able to trade profitably. You just need to understand something little and understand it well enough. So we weren't going to trade on this day. We weren't going to trade on this day. Okay, on this day, we might have been looking for reasons to sell, depending on our order flow, because we have the 200 above, the 50 beneath, and bam, it didn't give us any reason. There would most likely have not been any LSB, blah, 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 nothing to trade. The next day, everything was jumbled up. We will not be looking at opportunity to trade. I hope somebody's getting something here. How to save ourselves the trouble of sitting down in front of a pair and having it not do anything the whole day. Right now, look at this day. Aha, we have the 200 above, the 50, and the 13. Now we are looking for a reason to trade on this particular day, which happened to be yesterday. Right, so let's go to yesterday 15. On the 15 minutes, now we're looking for a reason to trade. If you want to trade BTMM, you'll find a reason to trade here. If you want to trade the institutional order flow, you'll find a reason to trade on a day like this. All you need to do is go down to the 15 minutes on a day like this. You're going to have a type 1, type 2, or type 3 form of M, and there you are. It stop hunted the Asian high, bam, bam, gave you an M, dropped, came back again for Asian session, gave you another M off the Mayo, and it dropped again, and it has been dropping ever since then. But how would you have framed up your entry and told yourself, I don't want to get interested on these 3 days? Is because the moving averages are bunched together. And now you know to leave this pair alone. One more, this is going to be the last, and we'll call it a wrap. We're doing this because, sorry for you guys not in Nigeria, we have public holiday tomorrow. So that notwithstanding, we still have to wake up early for London again. Right, so here again, look how powerful this is. Just look at it. Just look at this, ladies and gentlemen. You are on the 1 hour. You want to see your moving averages stacked. So on this day here, on this day, sorry, something is happening. Come back. Okay. So here we are. On this day, we are not looking for any reason to sell. Why? The moving averages are not properly stacked. On this day, we're looking for reasons to sell. We had a reason, took out the Asian high and dropped on to London, then pulled back again. We might have had another reason to sell, because if we come here on the H4, this might have been an order block on the H4. In fact, let's check. H4, boom, there it is. It retested an order block, this order block, and then we sold. Right? Again, 1 hour, please. 1 hour, 1 hour. So here we are. Again, our moving averages are still stacked. We are sellers. We sell. Again, we sell. When it pushes up, we are happy because we know it's pushing up into discount to give us a reason to sell. All this push up will most likely have pushed up into an order block. All you need to do is go to H4, you'll see it. Boom, that's the order block there. It pushed up into it and it sold even the more. Right? Again, your moving averages are stacked. Anytime it pushes up, you're looking for reasons to sell. Anytime it pushes up, you're looking for reasons to sell. Anytime it pushes up, you're looking for reasons to sell while your moving averages are stacked. All right, enough said for one day. Somebody said these moving averages are lagging. Oh my, even candlestick is lagging. Even candlestick is lagging. I tell you the truth. Price has to move before you know an order block has been created. When price trades below a bullish candle, you don't know it's going to be a bearish order block until the candle closes. Why? You don't trust a candle until it closes. So I don't believe that don't use indicators. Do you know how to use them properly? And that's why I said at the beginning that we will use our indicators different from the way the majority use it, because the majority loses. So these indicators are lagging, but please, the fact that they are stacked, how do you do that? I mean, they are stacked. They are stacked. You wake up in the morning, they are stacked. It means they are stacked. Nothing lagging about this, right? Not it's because time has gone. I would have done what will I call it, a back test for us using an EA back test, and you see that what we're doing, we know is that it is stacked, it is stacked. People trade BTMM. Some of the best traders, profitable traders I know, trade BTMM, and they use all of this. So don't get into the hype of naked charts and the likes. Even Michael himself told us that the earlier part of his career, he was trading, I think, the 50 exponential moving average and the stochastic, and he was doing pretty well before he now started moving into that. So don't get into that hype yet. Right, so we'll be stopping here. This is part of the things we'll be discussing in the fostering class. We discovered a lot of people find it difficult because many of us spend time on 15 minutes alone. We spend time on 15 minutes and a small push to the upside, which BTMM guys will call the vector. We will be chasing price. How do we do this? How do you know that you're approaching an order block? So we initiated what we call the modified IOF. So on the 1 hour, we are basically seeing our 4-hour candles, and on the 4 hours, we are basically seeing our daily candles. So we know when price is trading into an order block. So price traded down and price traded into this order block, we have our entry conditions to sell. Price traded down, price traded into this. So, and here on the H4, I am seeing my daily candles. I'm here on the H1, I am seeing my H4 candles, and I can take my decision based on certain criteria to go long. It's been a revelation, and I'm hoping to see more of you. We'll be starting on the 7th of November. So when we start again, as usual, I'll be most likely very, very silent to a large extent on Simply Pips. Just trade the best you can. I hope to see as many as possible in the fostering class. Of course, those of you that are old students of the fostering class, whatever lecture we're going to have, the Zoom link will be made available. You can always join us. Once you are with us, you are with us until you decide to do otherwise. So have a wonderful night, every single one here. Yeah, enjoy your day. Bye-bye.